Hey, everybody, and welcome to today's LP Roundtable, where we're going to be discussing the current investing climate. I've got three incredible panelists joining me today, Dario Balena, Mark O'Hara, and Martin Tobias. And I'm going to have everybody introduce themselves in just a moment. I'm Sam Hewlett. I'll be moderating today's panel. I work with VC Labs, focused on capital networks initiatives. I also help run a program called the LP Institute, and also am an active angel and LP myself. So before we get started, just a quick disclaimer. The content presented today is not directed to any investors or potential investors, and it does not constitute an offer to sell or a solicitation to buy any securities. So now that the disclaimer is out of the way, I'd love for the panelists to introduce themselves. Martin, maybe we can start with you. I would love to hear just, who you are, what your day job is, and maybe just a bit about your experience as a limited partner.
Okay, thanks. Hi, Sam. Thanks for having me. So I'm Martin Tobias. I am a three times venture funded CEO. I took two companies public. I used to be at Microsoft. I was an angel for a long time with about 250 investments, and I'm currently a GP at Incisive Ventures doing pre-seed investing. But along the way, I've also been an LP. I'm an LP in 17 funds. The first fund I ever invested in, I was working for Microsoft, and I met this guy in the Valley that was called Ron Conway, who was going around handing out checks to everybody he could find, and he gave Larry and Sergey their first $250,000. So that turned out to be a good fund. I currently I've joined about four funds recently. Mostly my LP investing now is targeted at investing in similar funds to my VC fund and using those as deal flow and relationships for follow-on financing to my VC fund.
Thank you, Martin. Dario, can you introduce yourself?
Gonna be hard after Martin. It's an awesome experience so far. No, in my case, it's more like family office investment director role. So what I'm doing now is helping one of the high net worth individuals in Spain, which has been building a reputation in the retail industry for the last decades. Now he's building his own portfolio, and one of the strategies is investing in funds and also investing in startups, right? So during the last 3 years and a half, we've been investing in funds over Spain, Mexico, north of Europe, and US. And right now we're investing more in startups directly. We have like warehouse investments with other big family offices, but mainly we're analyzing other markets in case we can work with them, right? Before that, I've done venture capital for 8 years. I was based in Israel. Then I did something in Switzerland, then in Spain. And I'm part of Common Fellows and other like kind of fellowships about VC. So happy to chat about the trends and what we're seeing these days.
We'll certainly be getting into that in a moment. And last but not least, Marco.
Yes, hello all. My name is Marco O'Hara, and I'm investment lead at Desal Capital. I started as a founder in the 80s. First company was founded in 1986. That went belly up, and then I've founded and co-founded four other companies, which went much better. We got some exits in the 90s, and then I got myself into family office business. And around year 2000, a little early, I was asked to join as a general partner in a venture capital company investing in mostly in pre-seed and seed and Series A tech companies. During that time, we made also investments as LPs into funds. Then we got exits from all of our companies in the portfolio, which is quite incredible, but that's what happened. And around 2006 or 7, early 2007, I was asked to join a public pension fund to run their private businesses, which I did for 15 years almost, investing mostly in funds, also some directs and co-investments. I've been involved in around 260 fund investments so far. 2011, we started a emerging markets or managers program in a pension fund, which has been quite successful. And here I am actually investing in emerging managers at Desal Capital.
Thanks, Marco. So as you can see, we've got quite a wealth of information on this panel today. I should have mentioned too, just a quick word on the format. So we're going to, have the discussion for probably the next, 30 minutes or so, and then we'll move into a Q&A. So if you want to, start populating questions along the way into the chat, that's probably going to be the easiest way to facilitate questions. So I'd like to start off, given the incredible experiences you all have had in the venture capital industry, I'd love to hear whether there's a particular moment or an experience that really stands out as a highlight along your investing journey so far. So maybe we'll go back to Martin, but feel free we can really go in any order here.
Well, somebody mentioned to me the other day, they said, "Hey, Martin, you're a 3-cycle investor." And I go, "What's that?" Well, I've been investing for so long, like I've been in the different bubbles, the dot-com boom in 2000, and then the 2008 great financial crisis, and in 2020. Those are the 3 major booms and busts that we've had. And for me, the things that stand out are that, we've had these waves that have come through. Some are technology driven, some are economic driven, that can be real opportunities. I was at Microsoft, before they launched Windows 3.1. And Windows 3.1 was a huge inflection point for the industry. Everybody could see it because it was going to replace Novell NetWare and all these things. And then, cloud or mobile came along with the iPhone, then cloud came along. Today, we're in this environment where AI is the hype thing. But for me, the moments that stand out are when you realize, because you've seen some of these other trends, that you're at the beginning of something that could be a major tectonic shift. I knew that cloud was that. At the time when Amazon launched AWS Cloud, I was running a big company, and we had to buy our own servers, manage them at Exodus. And I knew all that fixed asset stuff. And I'm like, oh my God, it's so much easier to just buy these things on a variable cost basis in the cloud. It's going to enable so much more growth. And I think we're at one of those phases now with AI. We can talk about that later. But for me, the exciting thing in this career has been to realize that you're at an inflection point where everything is going to change more than once.
Dario.
Yeah, that's a good topic. Of course, I don't have this much experience being an LP. I've been only 4 years doing that, but we've been quite active investing in big tickets, actually, because the family office has started recently to invest in startups. And one of the reasons and one of the things that took me like more surprise, or I got more surprised, was when we started to investing in new trends like AI, for example. We already had an exit of one company that we invested in. In the past, when I used to start working in the tech industry, I worked in IoT, and IoT was also the height of the trend, the same as blockchain, the same as other industries. But so far, we didn't have these quite fast exits. Only the 3-4 first players were having some noise. And now in AI, I feel like we're in a similar situation with the difference that probably this is more similar to what Martin was saying about the cloud, or about the internet, or the phone. There's new markets and new opportunities. So for me, we're really, really willing to invest, especially in San Francisco-based funds that invest in AI, which we believe is one of the trends that will continue for the next years. Even though maybe OpenAI will get most of the market, that's what many trends are saying. But so far, we're really excited about this.
And Marco.
Okay, what Martin said makes a lot of sense. I'm glad to say that we have both survived 3 different super cycles, that we are not 3-time losers here. We are still around, and that's something I'm extremely happy about. And also it gives us some confidence about it, Things seem to be different. At the same time, they might not be that different. There is always something going on there. And I think that this is one of the great opportunities we are actually living in right now, compared to those which investors had after the dot-com crisis and even GFC. The one thing is that I try to filter the noise nowadays, and take it a little bit easier because it's going to be all right.
How do you know
Absolutely.
you survive already, Martin and Marco? Because this is not ending, right?
Look at
we're
our
still in the third wave.
I know my portfolio well.
Yeah, my portfolio is doing well, but the more important thing is to understand, for example, where you are in the cycle. For example, as a GP, I was the benefactor of the bubble in some ways. I was a pre-seed investor in OpenSea. 2 years later, they priced the thing at 13.8 billion, 240x in 2 years. Because I'd been through the cycles, I'm like, this is fucking crazy. I know this is not a sustainable valuation. I know I'm in a bubble. So what do? I sell half my position at the top because I'm not one of these guys that's like, oh, it could go up even more. Like I had the context to be able to take actions in the middle of a bubble to take some money off the table. And I think that is the primary thing, that you learn going through these cycles is where you are in them and what to do in them. For example, when valuations got crazy, we just finished probably a 12-year bull run in venture capital. We've never seen, especially the last 2 years, number of unicorns that were created and all of this stuff. Because I'd been through the cycles, I knew that we were in somewhat of a bubble. I didn't know exactly when it was going to end, but I did not participate at the end of the bubble in many of the premium valuations. Hopefully, I have a lot of friends at Tiger and those guys that came bowling into the seas at those high valuations. I kind of had an impression that was not going to be a good strategy from the beginning. We stayed very disciplined in our price and stayed at the pre-seed, and didn't pay these $30 million valuations for pre-product companies. Stayed fairly price disciplined. And that's what you learn to do over time, is to not get caught up as much in the hypes and understand where you are in the hypes, when you're making your investments.
Yeah, talking about cycles is a great segue here. So I'm curious on, what each of you think, Martin, you've sort of answered this, but, what your views are on the current market. Are we still in a bit of a downturn? Are we kind of coming around the bend? Dario, maybe your thoughts here.
I have strong opinions here because all my friends are LPs and they are investing in the area, right? So when we talk about the returns that we expect from the funds in the last probably 2 years, the reportings are not good. And sometimes even when they report to us that their data are good, is because they didn't adjust it to reality. And what Martin was mentioning about the unicorns, that's another thing we saw in the investment firms we put our money on. They used to brag and say a lot, like, we have this many unicorns. Now I think it reduced like 3 times from 2021. It's only 200 unicorns in the last year compared with the 700, whatever. And we've seen that also in the funds that we invest in. So I believe we still have way to go, but maybe I'm wrong. I hope I'm wrong.
I would say that the first warning signs I've thought about, that's what I was thinking about, maybe came around 2019 or 20. And the reason for that was that I could see some pretty serious overconfidence in some of the GPs. And most of them, which were a little bit, they didn't have experience, and they were just, like talking that this time it's different. It's never going to end. It's totally okay to pay these prices. And I said, well, we've seen this before, but obviously timing is extremely difficult. But it's good, extremely important to be disciplined. That's the key word, not to get overexcited about things. My personal view is that I think that we are almost at this point that we are going to see recovery. The problem is that it's always easy to see that afterwards. But my bet is that the worst is over. And also because we are investing in funds, like the vintage 24, maybe 25, these guys, GPs, they're going to invest in 24, 25, 26 into these companies, They're not going to deploy all the capital, once, but they're going to wait some, and you get that kind of diversification. And I also think that one of the key points that I've learned as LP, that I learned at the pension fund, was that we kept on investing. We invested some even when we knew that we probably should not, because timing is extremely difficult. But you might want to be a little bit more disciplined. But now I think that's at least from my point of view, because we are investing in emerging managers, smaller funds, investing in pre-seed and seed like Martin's fund is doing. I'm pretty confident about that, myself.
Yeah, it's a great point that you. Oh, go ahead, Martin.
Oh no, what I was just going to barrel on there. I wrote a piece on my blog called "The Great Asset Repricing" about a year and a half ago, and it was basically saying, we've seen this before. 100x multiples on SaaS companies is not sustainable. Things are being repriced, and frankly, the repricing is good for the economy and good for the startup economy, because those never going to end valuations are not good for anybody. And I would agree with Marco that I said at the time that the pricing was restarting. It's unclear how long it's going to last. Unfortunately, what happened in 2021 and 22 is some of these companies raised so much money that they could delay the repricing. And so you've got 1,250 unicorns or something like that. Many of them haven't raised money for 2 years, but I think we're probably 50% through the repricing. You're starting to see it. I mean, Instacart went public at a down round relative to their last valuation. You're starting to see a few of them, but usually what happens is that people put that off for as long as possible and hope beyond hope that the price stays the same. But you're starting to see these unicorns getting repriced. You've already seen Series B and C get repriced, almost stalled to zero. And you've also seen even pre-seed and seed valuations. Seed valuations are roughly the same, maybe down 20, 30%, but B and C valuations are down like 50 or 60%. But it has sort of gone through the series stage in venture. So one of the things I have adjusted, because we are in a more capital constrained environment in the later rounds in pre-seed, is, up to 2 years ago, I was happy investing in a company that had 12 months of runway in pre-seed, because you could pretty much reliably raise money every 6 months. You just raise your flag and go, I got 20% growth, give me another round. We are not in that environment right now. In pre-seed, I'm only investing in pre-seed rounds that are providing 18 to 24 months of runway, because the median time between pre-seed and seed has basically doubled the length of time it takes you to raise that money. And the reason is because the traction metric for that seed round or that A round has basically doubled in the last 2 years. 2 years ago, you could get a Series A with $1 million of ARR. Today, that's $2 million. So you have to get farther with your money. It's going to take a little bit longer to get those traction metrics and everything. Actually, I think that is a really interesting opportunity for pre-seed investors, because what that means is companies have to raise more money sooner at a lower valuation. So I'm able to buy more money, more of a company at a reasonable valuation. Then you add on AI co-pilots and the productivity gains of all of that stuff. They can get farther with their money than they could before. I think it's a really unique opportunity for pre-seed investing. While despite the fact that the later stages are more constrained, you can get farther in pre-seed today.
Yeah, it's a great point. And one of the things that I was going to ask, and maybe we'll just jump into it now, is how the current environment has been affecting emerging managers versus slightly larger, more established managers. Anyone have opinions on that?
Well, I can say, like, as an LP, my Series A funds have fucking slowed down like crazy. like where they might do 5 deals in a year, they're doing like 1 or 2. It's really crazy. In pre-seed, I have not seen much of a slowdown. I wrote 8 checks last year as a GP. I'm going to write 8 checks next year. I think pre-seed is still people are still deploying capital. Seed is going as well, but the A and the B very, very slow. And the reason is just because they can be selective and they should be selective. And they're still, if we're maybe 50% through the repricing of unicorns, you're also going through the repricing of seed and Series A companies. The later stage VCs are being smart. They're like, we're going to wait for more traction. We're going to wait till you run closer out of money so that we can get a better valuation.
Yeah.
They're not interested in YOLOing things. They're interested in maximizing the traction that they get relative to the valuation that they pay. There's a benefit for them to wait. They get a better negotiating position, and companies are having to wait. Yeah.
So is there a piece of oh, go ahead, Darian.
Sorry, so I'm connecting with that. That's a point I wanted to make, and probably people don't talk about enough. It's that we don't care that much about if the return is big or not. It's how soon it goes. So when Martin says that their funds are not, they don't have any hurry, the problem is the LPs we have, because we have an opportunity cost of investments that we put our money otherwise in another place, probably we will have them back. So the main issue that I'm having right now is the liquidity. So to share a little bit my point of view, I believe that nowadays it's harder to get liquidity, and I'm only getting liquidity on the assets that has some EBITDA positive. So together with what Martin was saying, that you have more money for more equity, and probably it takes longer. You can build shorter with AI. The other thing is that you invest in companies that have an opportunity to switch faster to profitability, because what I'm realizing is that when someone comes to acquire us or some of the portfolio companies, they focus on that. So that's one of the reasons that we can continue moving our money, which is my job. If I'm waiting 3-5 more years, it doesn't matter if it gives me a 5x, if it's not giving me like a continuous money when I need it. So VCs have this problem that we need to solve.
I would say that LPs are very different also in that respect. Some people are capital restricted, and some people rely on cash flows. And then again, there are some other investors where it doesn't matter that much. But on the other hand, it's also a sign of maybe sometimes making an overcommitment in that strategy, because it's quite difficult to exactly understand the cash flows, even from a diversified portfolio. What I learned from the past was that you got to be in this asset class as a long-term investor, really, and be prepared for that, because the holding periods are longer, and investment periods are longer. And when I started, a friend of mine told me, as an LP, the job keeper is to triple your money every 10 years after the expenses. Triple your money every 10 years. It's pretty difficult, for most of the fund managers, but it's obviously it's simplifying these things. But then again, the other thing which I would like to mention is that when we are talking about the trends and timing the market and so on, the other thing that I found out is that as an LP, the most important thing for me is to find the right managers, regardless of the markets. It's always about selecting the right managers, because you can be in a perfect market, like founder friendly or, investor friendly or whatever you have. But if you pick up the wrong managers, your, returns are not going to be satisfactory. If you're able to find the right managers, the returns are going to be at least okay, even when the times are difficult. But what I'm trying to do is that it's all about fund selection and also about portfolio construction on a fund of funds level or on portfolio level, which makes it a little bit different. The other thing is that I think that the biggest mistake you probably can make is that you try to time the markets, because obviously see what happened with CalPERS, where they tried to do that. They call it a lost decade. They screwed that thing up, and now these guys are, deploying more capital in venture capital than in 15 years. because now they are trying to time the market again, but this time they might be luckier. But last time when they decided not to invest anything, they made a big mistake.
Big mistake.
Big mistake.
I'd love to dig into to a point Martin had made around the Series A slowdown. I'm curious, maybe for Martin, do you think part of it is also that, people don't want to, price the companies? It's hard to set a valuation in this environment. And/or, folks want to slow down deployment because it's a tough fundraising environment. And the faster you deploy, the faster you've got to be back out fundraising.
I think it's somewhat both of those. But I think the primary driver is just that all of the people that were doing Series A, they saw the number of people that raised seeds and pre-seeds. They saw the amount of money there, and they're like, we want to wait and invest in the top 5% of companies out of there at a better valuation. And it used to be that you could get into those 5%, but you would have to pay a premium, right? Because it was a hot company and it was gone through YC or whatever. But what they realized is that they could wait because it's a capital constrained environment and get it at a reasonable price. And that's, I think, the fact that they're just being more selective because they can is the primary driver. I don't think it's necessarily about not wanting to go out and raise their money. It is just that, like, for example, I even see this in pre-seed. I see a pre-product 3-person company who hasn't built an MVP yet, trying to raise $1 million at a $10 million valuation. And then the next call, I have a pre-seed company that's been started for about 2 years, has got $700,000 of ARR revenue and like a $6 million pipeline, also priced at $10 million. Right? And so you're seeing a huge variance. And when, as a Series A guy, you start to see tons of variance like that, then you say to yourself, okay, now I have to decide what I'm going to do, right? How much risk am I going to take? How much traction? And you now have the freedom and the time, because rounds aren't like YOLO happening like wire by midnight, by Friday. You have time to do diligence. You have time to call all the competitors. You have time to do real diligence, which I think is better for the overall VC ecosystem. But that's what these Series A guys are doing, is saying, let's say I like this guy. Okay, I'm going to go and look at the 10 other competitors. I'm going to look at the traction, the valuation metrics of my opportunity to invest in their competitors versus this one. And I'm going to pick the best one after sort of boiling the ocean. It's very, which is, I think, a much better practice for venture capital than what we had for the 2020-21, which is, here's the deck. Can you wire on Friday?
It was running out of fear of missing out all the time, and we could see that because the information that our funds sent to us was not as concrete or extensive as it used to. When Marco was saying that they did this job that now they're doing again, this due diligence, this deep dive, because this is science-based also.
This is quite funny, because when I'm actually thinking about maybe 2019, 2020, I saw that even the same behavior with some of the GPs raising money for their funds, They thought that it would be a walk in the park, And the attitude was that if you don't do it, get the hell out of here. As an LP, And if you say something like that to an LP, he gets the hell out of there permanently. So there could have been, that kind of behavior even with the GP-LP relationship. And also founders and GPs. But I would like to ask Martin a question from you. Do you see a lot of down rounds right now? Or are they flattish or down?
Knock on wood. Where's the wood? I have not had any down rounds in my portfolio yet. But what I'm seeing more is flat and longer to raise rounds. I can't tell you how many YC companies I've seen that got the $20 million pre-product, pre-revenue valuation out of YC a year and a half later, raising again at 20. because they didn't get far enough. And 20 is a reasonable seed valuation now for a company with $500,000 of revenue. I'm seeing a lot more flat rounds than necessarily down rounds or slightly up rounds. For example, I invested in a company, one of my portfolio companies called Uptime Health, and they had $1 million of ARR when I invested. I invested at a $12 million valuation. Pretty good revenue to traction metric. They just raised a Series A, $13 million at a $40 million pre-money valuation. The revenue so priced at 4x revenue in a Series A. That's almost a discount to the public markets. I think it's fair. The investors who wrote the check are getting a very good price, but that's more of what I'm seeing. So rather than the public market being or private market being 3 or 4 times the public market variables, you're seeing private deals done similar to the public deals and with a better growth rate, which is a great investment for the venture capitalist, but it means a lower markup for me as an early investor. For example, I got a 2x markup on that deal, which I'm happy with, but a year and a half ago, I would have gotten a 5x markup.
That's right.
Right. So I'm getting a lower mark, and that goes back to the point of, there were whatever, is it 1,300 or 1,500 unicorns created in the last 3 years. I think if I look forward the next 3 years, we're not going to have 1,300. We might have 300 or 400. So we're going in the forward-looking basis. We're going to have far fewer unicorns.
I think you may have cut out.
But hopefully, what we're going to have is more. I have for example, in my fund, I have 2 companies that I invested in pre-seed that are profitable after a year and a half. That's very unusual for a pre-seed fund to have a profitable company even within 2 years. I think you're going to see more of that going forward. Lower multiples, but faster path to profitability, less unicorns, but more sustainable companies that are growing at reasonable growth rates on reasonable cash flows, which I think is better for everybody.
And we should not forget. Oh, sorry, Michael.
Sorry, another question maybe on that. We were talking about pricing and down rounds or flat rounds. How about term sheets? Do we get that good old leak pref kind of situations as pretty aggressive as we had for 20 years ago after the .com? Have they come back?
I have not seen any structuring in any of my term sheets. No. I've heard of it. I have not seen it in my portfolio, and I would encourage CEOs to not go for that.
Yeah, absolutely, because it was extremely aggressive for 20 years ago, and it was very bad for the companies, very bad for venture capitalists, very bad for everybody. And I kind of wish that it won't happen again.
Yeah, I had a friend that did one of those deals, and it had, it wasn't liquidation pref, it was a put right, a 10-year put that the venture capitalist had, the right to sell the stocks back to the company if there had not been a liquidity thing. And that was particularly onerous. The VCs end up executing it, and this company had to buy their shares back, despite having no liquidity. Those kind of terms, they just put constraints on the CEO's ability in the future, and it's not very good. I hope they don't come back.
Yeah, me too. I saw, as a matter of fact, 20 years ago, good company, but they had this full 100% anti-dilution clause there.
100%
anti-dilution. I mean, that was bad. You know what's going to happen.
Yeah.
Yeah.
Awesome. Well, maybe we can move in, we'll probably do another 5-6 minutes of discussion, then we'll kind of move into Q&A. But I wanted to, kind of briefly touch on, trends. I know everybody on this panel is excited about AI. So I thought I might ask, I saw recently there was an announcement where Menlo Ventures has, teamed up with Anthropic to launch this $100 million AI fund. And my question is, the idea here is they're using an LLM to help with, investment decision making. my question, is this the future for capital allocators, or are we sort of, is this marketing? Is this kind of a hype cycle?
One of my colleagues from Drive Capital, they are using this kind of tools now, this kind of data analysts to check if the trends and the startups that they select are better or not. And so far, they've been proving good investments. But I think we don't have, at least I don't have enough data to prove that that works or not. I hope it does, but I don't know yet.
I think those kind of tools are very applicable for Bs and Cs and later rounds where you have quite a bit of data to model. I'm pretty familiar with Signal Rank, which is an algorithmic Series B investor that has back tested their algorithm. They've deployed a bunch of capital. It's still a little early, but I think in the later stages, those tools can be very helpful. In the very early stages, there's just not enough data, and you have to go back to the pattern matching of a person. I've personally met over 10,000 CEOs. I can tell you within 5 minutes if the team I'm talking to is the top 5% of teams I've ever met. No LLM will ever be able to do that. I think those are much less useful in the early stages.
If that happens, I hope that I'm in Florida.
Exactly.
That's great. Okay, well, maybe we could go around too. I'd love to hear if there are any, additional sectors or trends that you're particularly excited about, through the latter half of this year and maybe, going into early 25.
For us, we have a mandate. It's mainly retail because of the background, but I'm really interested in everything related with the geopolitical sector, defense, and everything related with that. We believe that it's going to be new tools and a lot of things going on because now the geopolitical spectrum is based on the decisions are based on this variable. Even corporates, we've seen a lot of corporates taking like new analysts and this in this text. Also, a specialized sector is something that I think is going to grow. In the past, it used to be more generalistic funds. They will start to shut down. I'm really bullish on creating more liquidity again. I believe that maybe crowdfunding needs to rebrand themselves. I don't know how it's going to be. I would love to see your opinion. And also, yeah, of course, there's been a decline in VC, but generative AI has been pushing back the trends in SF. So it means that there's an opportunity for that.
Marco or Martin, any other trends you're really paying attention to?
Well, not really. No, I'm trying to filter the noise, all the time. I'm trying to find the good managers, regardless of if they're generalist or specialist. I still think that is finding the right people, as an LP. In particular, because we are investing in emerging managers, sometimes first-time managers in teams, but emerging managers, it's all about the people and their ability to make buck, and that's how I see it. It's almost like, I would say that it's almost like to find a good founder. Not exactly, but it's almost like, even it's in particular with solo GPs, it's so important. It's all about the person.
Yeah, I agree with that. I would say that the trend I'm most interested in is something which I've gotten from a macro, and it's not AI. It is this idea that we are at a time now where it's possible to create vertical market software versus general purpose software. One of the trends I'm big in favor of is anybody that wants to replace Excel. We went through a time, Excel was an amazing tool. I mean, before the spreadsheet, like, people had adding machines or whatever. But what happened is that people took these general purpose tools that became very cheap and easily available, databases, spreadsheets, word processors, and they cobbled them together to solve specific vertical problems, but they weren't really that good for that. We're in a trend now where the cost with cloud and AI and the cost to develop a vertical market solution, which specifically does what a particular industry needs to do versus using these general purpose tools. We were in a trend, up until about 2 or 3 years ago, where people were using these general tools, Slack, Excel, WhatsApp messaging. But now you've got, because it's so cheap and fast to build software, you can build something specific to a vertical For example, I just invested in an AI company called Procurable AI, which is doing something with AI to solve supply chain intelligence, pulling things out of Excel spreadsheets and previous ERP systems and stuff like that. Anyway, but you can build something specific for a supply chain manager that solves a specific problem for him. You can build it very cheaply, and he doesn't have to use these general tools that are duct taped together. And you can deploy that and you can get customers very quickly. I think the verticalization and the defragmentation of things, I'm already seeing. I'm not fundamentally a retail investor, but I love Amazon, but I'm also seeing vertical markets like for tennis shoes getting lots of traction, or for specific categories, right? You're seeing the defragmentation of e-commerce because a marketplace for a specific category of goods can better serve that category than the general marketplace. And you're seeing that in B2B applications as well. So I think the verticalization and personalization and vertical market software is an underreported and underinvested trend that is getting rocket fuel by things like AI copilots that help you build those applications and deploy them faster than ever.
Thank you. All right, folks, I think we're going to move into Q&A. We've got about 15 minutes remaining. So first question. So I think what's being asked here is, basically, what are you looking for when you're making an investment as an LP into a new manager? What are some of the signals that you're looking for and using to sort of evaluate a new fund?
I think this could take hours. It's a big question, but
let's keep it simple then. Maybe just one thing that kind of most stands out to you when you're looking at a new fund.
Because we are mostly investing in emerging managers, new funds, even first-time managers, it's extremely important to get the right people, the right investor there. It is the most important thing for me. If that doesn't match up, it's no go. I can't do it. Even if they had the best thesis and strategy, but if they're not the right people to do that, it's a no-go for me. You need to get the team and the people. Absolutely.
I can make a comment. I'm mostly looking to deploy capital now to managers in other geographies that have a thesis similar to mine, so where I can use for deal flow. So the number one thing I'm looking for as an LP is, do you have deep connections into a market, and do you have some flywheel that is going to allow you to get into the right kind of deals that I want to be in that category? And if you're an LP that's looking for co-investment, that's one thing you might use as a criteria for choosing a manager is, are they in an ecosystem that you want access to? For example, I'm an investor in 2AM Ventures in India. It's a pre-seed fund run by Herschel Mehta. His cousin runs 100X VC which is basically the YC of India. He's got an inside track to all the top pre-seed deals in India. I wanted an inside track to the pre-seed deals in India. I invest in his fund. Okay. That was easy.
That's a similar strategy we're following because we invest mainly in Europe. So now we're entering SF and entering a new market. Also, we checked track record because, difference to Marco, we don't invest much in emerging managers. Maybe with VC Lab we will start, but from now on we have not done many emerging, more established ones. And the other thing is the personal connection. I mean, I know it's a little bit biased and non-professional, but the truth is the relationship it's easier when you get along with them and you want to invest in them. Sometimes when I work with the family, we're like, hey, we love these guys. Even if they fail, we've been happy to work with them. So I don't know, it's a feeling, but sometimes it helps a lot.
There's another question about how each of you feel in terms of investing in solo GPs. Is that something you're willing to do? Any particular considerations when doing so, making an investment decision there?
We had a bad experience with one GP, and I want to be straight honest that he died he passed away. So he was not a solo GP, fortunately. So he had a team. I don't know what we have done if it was a solo GP, but I know experiences of really brilliant solo GPs that have been delivering even better results. So data is not clear there. So for me, it doesn't matter.
We invest in solo GPs all the time.
I invest in solo GPs as well. I'm a solo GP. Most of my funds do have multiple people, but it also relates to the stage and what you want to do. A lot of solo GPs might be more senior investors who are doing a strategy that can be done by a solo. But some younger funds might have more partners because they have aspirations to grow AUM over time and become bigger funds. I think both strategies are fine, continuing to have small funds or growing your AUM. But as an LP, you should decide, is that what you want to do? Do you want to invest, $1 million in this fund and $5 million in the next fund and $10 million in the next fund? Is that what you're looking for, is to get into an organization that's going to grow? Or are you really just trying to back, a piece of that a particular person has? They're just different strategies, and I do both.
Another question from Deep, and I'm going to paraphrase this a bit, but saying, he's come across data suggesting about 10% of venture capital is allocated to the southeastern United States. Do panelists have opinions on whether there's a market opportunity to invest in, underrepresented geographic areas?
I would say, of course, there is. It's a no-brainer.
I would love to know more, Marco. Why do you say that? Do you have experience there?
Actually, we are trying to not to reveal too much, because we are not to talk about that when we're going to do so. But we have studied these different markets in the United States, like the West Coast, East Coast, Middle East, the Ohio, whatever you have there, and then the Southeast as well. And I learned something when I was investing in middle market buyout funds for 20 years ago for a pension fund, because we first thought that, well, they got to be from New York or Boston or maybe California. Then we found out that let's go to Chicago and let's go to some other places like Ohio, and we were able to find great managers. It's then again finding the right managers. And you can find good managers there, obviously, because the market is much more smaller there, like in Southeast or Southwest or whatever you have there. So you can't deploy as much money as you might be able to, like in California or some other places. But if you're able to find good managers, the returns can be very good. They are more difficult. Well, it's more difficult to find them. That's the problem.
That's true. What I'm seeing, I wish I could had the link in front of me. If I find it, I'll send it along. But I saw a recent study that was looking at geographic locations of unicorns and percentages over time. And basically what you see over the last 10 years is that, Silicon Valley is still the king, but their market share is dropping. So the percent of total unicorns, it's still the biggest bubble, but their bubble is shrinking. Why is it shrinking? Because other places are growing. So I had an LP ask me, why don't you invest more in Silicon Valley? Well, I'm in Seattle. I have no advantage in Silicon Valley. So what I'm doing is I'm looking in non-Silicon Valley. And by the way, the growth rate outside Silicon Valley is greater. There's less capital competition. So that's where the growth is. The growth is not in Silicon Valley. You're still, density and all of that stuff. I expect that trend to continue. Silicon Valley will continue to be the biggest bubble, but it's going to shrink in terms of a percentage of the total capital deployed and the total value created, because there are other places that are, especially with remote work and cloud and AI and everything like that, it just enables people to live wherever the fuck they want, and they're going to.
Yeah, absolutely. But I also had a link to a study about Southeast. I might be able to share that.
Okay.
All right, we've got another question from Ollie, who's asking about venture studios, which he sees as a growing trend, and whether you invest in venture studios as an LP, or sort of how you think about them as a particular, kind of subclass.
We invested in a venture builder, which is similar. I think it's not the same, but it's a little bit similar, and we had bad experiences so far. But I can just talk about one. So I don't know if in general. I know the one that was in Europe they closed, and most of the ones that started in 2019 also are struggling. But I don't know if it's a general thing. I don't know about you, Martin and Marco.
I have been pitched venture studios a lot. I have never invested in one. As a GP, I personally don't like the model. And so the benefit of the model is that they get crazy fucking deals. They get 50% of the company for $1 million or something stupid like that, right? Then I ask myself, as a CEO, would I want that deal? There's a venture studio in Seattle, which I love. They've made some good companies called Pioneer Square Labs. And their deal is they get 50% of the company up front. And the CEO gets 25% at the founding of the company. So what happens is the CEO ends up owning maybe 10% of the company after the Series A. If I start a company myself and don't use a venture builder, I can end up owning 50% of the company at the Series A. What I think happens in the venture studio business is that you get a negative selection bias against founders who can raise money outside that system. So I think you get a lower tier founder coming through that sort of a model. That's just my personal feeling. I've seen some interesting companies come out of that model. I think there's a negative selection bias. Also, you're limiting your opportunity set. So rather than saying, for example, as a GP now, like I'll invest in any CEO anywhere I find them, the best CEOs I can find. But in a venture studio model, you're limited to the people that are in your studio. You can't invest outside of the people that are willing to take your fairly negative deal for themselves. I think it's a poor model.
I haven't invested in venture studios so far. It doesn't mean that I won't do it in the future, but I haven't found a good one. Actually, I'm conducting a little bit a quick and dirty due diligence on one, which is not in California. It's also in a little bit underrepresented place, but difficult. So the model is quite complicated to me, at least. I don't get it really.
All right, and maybe we'll do this as a final question. I think it's a good one, given the backgrounds of everybody here for the most part. So the question is, given the fact that first-time fund managers often don't have a track record, what other qualities would you look for in a first-time manager to help you de-risk the investment?
One of the things is if they have a platform or something before, like there's an emerging that we're searching what to invest now, that they've done like a book that's called Blitzscaling. They've done awesome job before. They've been like creating a community. So we've analyzed that they have this kind of go-to-market to get the best startups, plus also some experience as a business angels. That also helps out to know if they can be good managers or not. And especially if they had success as CEOs and they've sold their company, that's also a thing that makes sense for our perspective.
The number one thing for me would be, first of all, I've never invested in a manager that had no track record. It's like, be a fucking angel, invest $5,000. I don't care. Like, you don't have to have written $1 million checks. But if you haven't even gone on Angel List and written some checks, come on. So I did talk to a manager the other day. It's like, I'm trying to start a fund and blah, blah, blah. And I've been, working at these big companies for 20 years. And I'm like, how many angel investments have you done? 0. I'm like, I don't understand. So you have to have some track record, even if it's angel, but it doesn't, if it's not a, big checks and venture, having community or some, deal flow. That the reason why some investments is good is that you still, even if you have a community, the question is the person good at picking CEOs? You got to get a deal flow, and then you got to be a good picker. And I don't know how to diligence the picker other than some kind of investment record.
I think I've invested also in some of these first-time managers with quite limited track record, but there was something very special about these people as founders. They were like these unicorn guys or serial founders, and they had their networks, and obviously they would be able to get some experienced venture partners and even some other partners with understanding how to invest in venture capital. But I also think that it's, regardless if you invest in funds or single companies, it's important to have some experience and the more you have, the better. But sometimes, it's difficult. As Martin said, that we would live in a perfect world if we could find people who've been doing this for 25 years, but we can't find them. You can't find them anymore.
All right. Well, I think we're at the top of the hour here. So I want to thank all of our panelists. This was a really fantastic conversation. I really enjoyed it. Hopefully everyone in the audience did as well. And we will see you next time. So thanks everybody for joining us.
Thank you, everybody.
Thank
Have a
you.
good one.
Thank you.